So you tap buy on your phone, and poof, just like that, you own a tiny piece of a company. It really feels like magic, doesn't it? But what's actually happening in that split second? Well, in this explainer, we're going to pull back the curtain and trace the entire journey of a single stock trade, from your screen, through the hidden gears of the market, all the way down to what it really costs you. Let's dive in.
I mean, it seems so simple, right? You see a stock, you hit a button, and you're in. But under that super smooth surface, there's this incredible world of rules, key players, and yeah, some hidden costs. So what is going on in that instant? Let's find out together. Every single trade, every transaction, it all kicks off with one decision. And it's not just about what stock you want, it's about how you want to buy or sell it. This is your opening move, your first instruction to the entire market.
And that's the big challenge, isn't it? The market is like this huge, chaotic room with millions of people all trying to buy and sell at once. You can't just shout, "Hey, I'd like some stock, please." You need a very specific language, a set of clear commands to make sure the market understands exactly what you're trying to do.
And that language is your order type. The best way to think about these is as the official rulebook for your trade. They let you take control of the two things that matter most, speed and price. Let's look at the two most common ones.
First up, you've got the market order. This is basically the get it done right now button. When you place a market order, you're telling the world that speed is your #1 priority. You're guaranteed to get your shares, but the exact price you pay might be a few cents different from what you just saw on your screen.
On the flip side, there's the limit order. This is your price is everything command. With this, you set a very specific price, the absolute highest you're willing to pay or the lowest you're willing to sell for. You get complete control over the price, but, and this is a big but, if the market never hits your price, your trade might not happen at all.
And this right here, this just sums it all up perfectly. It's the fundamental choice you make every single time you trade. Do you want to guarantee you get the stock, no matter the exact cost? That's a market order. Or do you want to guarantee the price, even if it means you might miss out on the trade completely? That's a limit order. Execution versus price.
Now, beyond those two big ones, you've got some more advanced tools. A stop loss is like your emergency eject button. It automatically sells your stock if it drops to a price you set, which helps protect you from big losses. A stop buy is kind of the opposite. Let's say you're betting against a stock. You shorted it. A stop buy will automatically buy shares if the price starts to rise, putting a cap on how much money you can lose if that bet goes south.
Okay, so you've placed your order. Now who's on the other side of that deal? You might think it's just another investor like you, but nope. Most of the time, you're actually dealing with a professional intermediary called a market maker. These guys were the lifeblood of the market, always standing by, ready to buy what you're selling or sell what you're buying. So how do these market makers make their money? Well, they do it through something called the bid-ask spread. It's this tiny little gap between the price they're willing to buy a stock from you, that's the bid, and the slightly higher price they're willing to sell it to you, that's the ask. That tiny little difference is their profit margin, and it's the very first real cost of every trade you make. And this chart here shows you exactly where that gap lives. See on the left? The highest price anyone is willing to pay to buy right now, the bid, is $49.75. Now look to the right. The lowest price anyone is willing to accept to sell, the ask, is $50.25. That 50-cent difference, that's the spread. The market maker lives in that gap, buying at the bid, selling at the ask, and taking that difference home.
All right, we have totally got the fundamentals down. So now, let's get into some of the more advanced stuff. Strategies the traders use to really pump up their results. These are incredibly powerful tools. But, as the slide says, you're kind of playing with fire here.
First up is buying on margin. In simple terms, this is when you borrow money from your broker to beef up your investment. So if you have $1,000, your broker might lend you another $1,000. Now you're controlling $2,000 worth of stock. This is called leverage, and it's a very, very powerful double-edged sword.
So just how powerful are we talking? Let's say you invest your cash, and a stock goes up 30%. You make a nice 30% return. Awesome. But what if you had used margin to double down? Well, that same 30% jump in the stock doesn't give you a 30% return. It gives you a jaw-dropping 55% return on your own money. The upside can be huge. But here's the other side of that sword. What if that stock goes down by just 10%? Without leverage, okay, you lose 10%. But with all that borrowed money, your loss gets magnified to a really painful 25% of your original cash. See, leverage doesn't pick sides. It just makes everything bigger, for better or for worse. And if your losses start piling up, your broker starts to get pretty nervous. That's when they'll hit you with a margin call. It's a demand. Either you put more cash into your account right now, or they will start selling your stock, usually at the worst possible moment, to make sure they get their loan back. It is the #1 risk of trading on margin.
Now for something totally different, short selling. This is how traders can actually make money when a stock's price goes down. Yeah, it kind of messes with your head, but you're basically selling something you don't even own yet, all in the hope you can buy it back for way less later on. So how in the world does this work? Let's just walk through it. 1. You borrow shares from your broker. 2. You immediately sell those shares on the open market. 3. You wait. If you're right and the stock price tanks, you move to step 4. You buy back the same number of shares at that new, lower price. And 5, you return the shares to your broker and you get to keep the difference as your profit. Simple as that. But here is the massive, critical risk, and it is a big one. When you buy a stock, the most you can possibly lose is what you paid for it, right? The price can't go below 0. But when you short a stock, there is absolutely no ceiling on how high the price can go. If you bet wrong and the stock goes to the moon, you're on the hook to buy those shares back at any price. Your potential loss isn't just huge, it is, in theory, infinite. And that's what makes this one of the riskiest games in all of finance.
We've covered the moves, the players, the advanced strategies. But there's one last, crucial piece of this whole puzzle. Making money isn't just about buying low and selling high. It's about what you have left after you've paid all the little hidden tolls along the way.
Think of these as the 4 big hurdles you have to clear. First, you've got commissions, the fee you pay your broker. Second, the bid-ask spread that we just talked about. Third is something called price impact. This one's a little sneaky. If you place a really big order, your own demand can actually nudge the price up before you're even done buying. And finally, of course, there are taxes on any profits you make.
And you really can't underestimate these costs. For a giant company, the spread might be tiny. But for smaller, less traded stocks, it can be absolutely massive. Just look at this number. For the smallest stocks out there, the average bid-ask spread is a staggering 6.5%. That means the stock has to climb 6.5% just for you to break even on your trade.
And this, right here, is why all of this matters so much. Over years and years of investing, all these little costs, they compound, and they can chew up a huge chunk of your profits. I mean, honestly, knowing how to manage these costs is just as important as knowing which stocks to pick in the first place.
So, there you have it. From the click on your phone, through the market makers, the high-stakes leverage, and all those hidden costs, that's the secret life of a stock trade. You know the rules of the game now, but the real question is, in a game where every single move has a price tag, does knowing the rules mean you're guaranteed to win? Something to think about.